Hi everyone, this is Naheen. I have done a presentation on automation in finance. So let's get right into it. Everything is changing around us. The world is continuously changing to adapt to the newest innovation that makes life easier, simpler, and less time consuming. I think those days are gone when people used typewriters and fax machines in offices. Keyboards and e-faxes replaced it. If these kind of changes are happening in offices, imagine what is happening in finance or what is expected to happen in finance in a couple of years. So this presentation is all about that. It's about delving deeper into the different subdivisions of finance, like corporate finance, retail banking, sales and trading, payments, financial management, etc., and finding out how automation is taking over in those places and how it's expected to automate in future, like in a couple years from now on. So, moving on, for the methods that I'm going to be using to conduct this research is basically I'm going to take a theoretical approach where I will find out, like I'll talk or I'll elaborate on what I found out after researching the different subdivisions of finance, how it's being affected with like with technology and these new softwares and AI happening in subdivisions like corporate finance, retail banking, like what I basically mentioned before. And yeah, I'll just explore those. And then towards the end, I'll in a couple of graphs, I'll depict my findings and the current progress in the automation. So moving on, corporate finance. Um, automation is happening in corporate finance, and it includes a lot of subfields like capital budgeting, as you can see on the slide, financial reporting analysis, mergers and acquisitions, risk assessment. Like these are all the subfields where under corporate finance where automation is happening. So like if you start with capital budgeting, it is critical to any company to properly do the capital budgeting, right? As it allows resources to be allocated efficiently to meet the day-to-day goals, market demands, and operational efficiency. Efficient capital budgeting allows the company's management to determine its long-term strategy. So that's just what capital budgeting does. So prior to 1987, everything was manual based, which whatever was happening in capital budgeting. In the launch of Excel in 1987 enabled more complex modeling and a shift towards strategic value creation. So like calculations like cash flow projections, net present value, internal rate of return, sensitivity analysis, DCF, discounted cash flow, all this could be made using Excel spreadsheets, and it was less time consuming. So that was again like a long time ago, like at least 40 years ago. So, but towards 2000 and late 2000, there was like a lot of automated softwares, programs that was being used. Or if I am to elaborate on those, for instance, I don't know if um it is difficult to okay, so Excel, even though it was like innovation from 1987, it did have a lot of like lackings. For instance, it was hard to manage large projects using Excel and track them in real time. The program is also not accessible for like shortcuts for multiple budgets because like different people have different ways of putting together a spreadsheet. So it is also not like it's not an accessible shortcut for multiple budgets. So using automated capital budgeting software like Cflow kind of gets rid of all these pitfalls or negative aspects of Excel. So Cflow uses basically visual tools with the drag and drop user interface for speeding up the order of tasks related to capital budgeting, which will again shorten the processing time. This might explain like the benefits that Cflow offers over Excel might explain why companies would rather use Cflow and like work automation tools like that instead of Excel to get their capital budgeting process done, because it does like streamline the whole capital budgeting processing time that would have required initially. Moving on to financial reporting and analysis. Okay, so technological innovations would not just stop at capital budgeting. Other fields like financial reporting and analysis and corporate finance is also undergoing automation. For instance, the Sage Intacct financial reporting software allows customized reporting based on math functions with cloud solutions and Salesforce integration. I can elaborate on that. So these softwares, like Sage, it enables businesses to make fewer errors in reporting numbers. They also provide other benefits like visibility and cost effectiveness. And also like using cloud solutions is very affordable and easily accessible because you can basically access it anywhere through an internet connection. Apart from financial reporting software, various other accounting softwares we have been relying on it for a while now, like QuickBooks. Nowadays, spreadsheet native FP&A softwares like Cube integrates with existing software like QuickBooks, which we have been using to provide advanced reporting capabilities that were previously impossible by a single software like QuickBooks. So, for instance, previously, limited functionality of QuickBooks could never guarantee advanced and customized financial reports, but for instance, profit and loss statements could be categorized by vendors, but not by market conditions, which limited the possibility of future planning and future market condition analyzing those. So future strategical planning, but now integration of Cube with QuickBooks makes that possible, as you can analyze future market conditions and plan accordingly, like your strategies. So again, that's just automation happening, financial reporting. Then I'll move on to mergers and acquisitions. So mergers and acquisitions are another again vital part of corporate finance, currently undergoing automation. M&A deals are determining like just gonna elaborate on like what it is, elaborating the worth of a company through valuation, then accessing any risk associated with the target company, then negotiating the merger, considering a deal, and finally integrating the two companies after the deal's closed. So before automation, these processes involved in M&A faced challenges as manual processes led to delays, increased regulatory rulings, and incomplete due diligence, which again, difficulty in merging resources, overall inconsistencies, basically. But nowadays, with automation and all these technological things available, this process have become much more easier and smoother. So firstly, the initial process of determining which deals to chase can be streamlined using deal sourcing automation. So platforms like CoreSignal provide firms with a more straightforward process for discovering new startups, as firmographic data is used to filter the companies and choose the right one. Also, like other than firmographic data, you can also use predictive lead scoring models to identify investments worth pursuing and the way the model works is by assigning a value to each generated lead after considering like the behavioral data, social information, demographics, etc. So that's just the initial stage. Then the due diligence aspect, then the OCR. So optical character recognition tools can scan deals and extract valuable information. Natural processing tools extract meaning from data and organize it in a like machine readable way, which the robotic process automation compares the data with rule-based inputs to generate reports. So these are the ways that like the due diligence aspect is being automated, and which also helps remove human biases, from evaluating companies which are being considered for the investment. And then beyond due diligence, bots are used for various filings based on the counter, like the company that, like, let's say you come up with an investment, a company that you would like to merge, the counter company's information. So their bots are being used to draft contracts, even though like human supervision is still needed, because these M&A deals are very expensive and you can't trust them over bots and RPAs to carry out the whole process. But the whole paperwork, filing, and all those regulatory side is being like slowly taken over by automated systems. But even though bots can be used for various filings, there's still human oversight needed, because these deals are very expensive. So after the merger, so let's say the contract's been done, after the merger, various automated data migration tools are used to integrate the data from the acquired company into a single database, making the process much faster and less and less time consuming, which it previously would have for employees in this field. Moving on to risk management, which is like another subdivision of corporate finance, going through automation. It involves risk adjustment, compliance, credit reporting. So these are the subsections under risk management, going through automation. So like other streamlined processes, it may lead to, like, I don't know, lower unemployment because automated tools are taking over, but I'm going to discuss those later in the presentation. So under risk management, banking fraud detection software called Xeon charges only $299 monthly, which is considerably cheaper than hiring employees for the same purpose. So this might explain why companies would rather use these softwares than hiring individuals for carrying out the manual process of risk assessment. Then, so I'm using these tools might also help risk managers, because previously they have to dedicate more time manually filtering through data, spreadsheets to identify gaps in data that portrays risk. And this manual risk assessment process is being automated through the automated risk assessment tools. Like there's this tool called LexisNexis Risk Solution, which assesses transactions to determine whether they pass or fail based on established automation index, and then provide instructions on the failed data on how to like overcome that. So that means what the tool does is it analyzes the reports based on organizations' specific needs and then passes or fails data from the reports. This again makes the life of manager very easier, because previously you were like manually, when it was done, people spent a lot of time like going through the whole data set and then manually assessing risk. Compliance under risk management is another part that is starting to go through automation, even though RegTech has not fully taken over. And it has started. So compliance a lot of the regulatory side, even though it has started to undergo automation risk, regulatory cost in ensuring businesses comply with rules are still they're high when done manually. That explains why RegTech is an initiative and is being actively done, even though it's not done on a full scale yet. So emergence of RegTech demonstrates the need to shift towards integrating technology in regulatory compliance for more transparency and flexibility in regulatory practices, meaning that like manual compliance processes will be like automated by RegTech as challenges faced by regulatory compliance will be addressed. How is this done? Well, this is done by connecting a regulatory change management process to organizational structures fed by world-class regulatory intelligence. So the regulatory change, how the RegTech is initially done, like how like the functioning behind it is the regulatory change management process will aid in managing the compliance process by linking these policies or rule changes, and or these rule changes will be linked to the policies. So, and it will be powered by high quality regulatory intelligence information, which informs these organizations or companies about the industry standards. So yeah, even though it has not fully taken over, it is a great initiative and it will transform the compliance segment of risk management greatly. Credit reporting and analysis is also another essential area in risk management where automation is taking over. So what does that mean? Well, like analyzing borrower information to assign a credit score is often like manual and time consuming. Thus, rating agencies like Moody's, they streamline the credit rating process by applying consistent methodologies across various financial statements. So which can be, so they can have a better time, like you don't have to spend so much time like looking over all the background information and assigning credit scores. Treasury management is also another segment undergoing automation. Automated treasury management tools will lead to real-time data availability, accurate database, detailed analysis, and fewer errors due to accessibility, and manual manual entries would not be like done at that point. Because treasury management encompasses risk and cash management, automated tools carry out various functions like accounts payable, accounts receivable, risk management, foreign currency payments, etc., etc. Treasury management tools will likely like save time and cost, as I mentioned before, giving employees more reasons to use them rather than hiring employees to get the same tasks done. So similar features can be also seen in cash flow management software, which given it provides access to real-time data to track the inflow and outflow of cash. So it's just an example of treasury management tool under cash flow. So cash flow management, so which the software, what it basically does, it provides access to real-time data, tracks the inflow and outflow of cash the company uses, and shows the exact amount of cash available, which will lead to better investment decision making when you know how much cash is available in hand as of now. Another cash flow management tool used in treasury management is Cube, which can adapt effectively to shifting financial circumstances and can be used to import data automatically into a multi-dimensional database from only one spreadsheet. So using Cube will connect all data sources into a single source and which can be analyzed or shared later, which makes life much more simpler. Moving on to wealth management. Well, wealth management provides financial services for maximizing individual customers' wealth, as we all know. Robo-advisors are being commonplace, like it's being used by banks like TD, Goldman Sachs, JP Morgan there to allocate investment portfolios. For instance, Goldman Sachs and JP Morgan use platforms like Marcus Invest. They have their own platforms. Marcus Invest and You Invest portfolios to offer robo-advisory services instead of relying entirely on financial advisors. These robo-advisors are provided primarily to like cut costs and improve overall efficiencies. Then the use of these services by managers gives a human touch to the automated advisory service, while it makes the transition from like completely human to not completely computer. So this makes the transition much more better. So because we can't trust these we can't trust these softwares to completely allocate portfolios, there's still human insight needed. It's not fully automated yet, but combining it gives a hybrid approach, combining the use of these robot advisory services with existing human supervision. Like both of them plays a very integrated, like hybrid approach towards investing and suggesting portfolios. So that's I think the best way. So not a lot of people don't end up losing their jobs due to it being taken over by automatic systems. Also, it does give us a fine insight of the data analysis from automated services. So integration of both. Moving on to tax compliance. Manual process of collecting and filing tax information is being streamlined so that businesses can continue to comply with the rules and regulations related to the tax processes. So the complex clerical process is simplified as e-files and automated tax form generation services are being used to meet the IRS deadlines while minimizing penalty fees. Research did show that companies which use automated tax compliance software, such as Comply IQ, are 50% of the time more likely to pass audits without penalty than the companies that did not use those services. So that's just an advantage. Now I will move on to the retail banking side. Retail banking is like another subdivision of finance and consists of mortgage lending, consumer lending, CRM, customer relationship management, insurance services. Automation is also happening and is predicted to happen in a lot of these fields, and I will mention it as I'm gonna elaborate on retail banking. So the digital banking experience that we have right now, it's created by offering multiple products and services through retail banking apps. For instance, like TD has tailored electronic deposit checks, like Swift money transfers, Zelle, like these features that the digital banking offers. These services are offered through banking like applications, right? Like, and it makes a very unique experience, customized experience for customers that we really enjoyed, rather than having to physically visit the branch for sending money to someone. Or you can just send it one click on our phone using the banking app. So furthermore, other than those features offered by the banking app, retail banking solution platform like nCino, as I've mentioned on the slide, they act as an integrated cloud-based system that that boosts the financial institution's transparency and productivity while meeting the regulatory compliance requirements. And how does it do that? Well, what nCino basically does is they use an end-to-end platform that extends across various functionalities of banking, like CRM, customer onboarding, account opening, loan origination, etc., and then integrates it. Thus, a middle ground is achieved, as physically visiting a branch for retail services is time consuming. So they offer these platforms where people can make use of it. And then customers, and it's not fully online because there is still help available, because customers are not used to performing these retail banking services alone, and they might have questions. So an end-to-end platform like nCino will provide all the retail banking services online while assisting and maintaining regulatory compliance. So again, that's something that makes us get help, and also not enables us to not take the additional difficulty in going to the physical branches and wasting time on the commute. Customer relationship management again refers to the techniques and procedures used by retail banks to maintain relationships and interact with their customers for a smoother customer experience. For instance, CRM consultants of Fiserv Bank use CRM technology to build and nurture long-term relationship with their customers. So the CRM consultants improve the execution of relationship selling by effectively using the CRM technology. However, even though we can use these technologies to like help strengthen relationship, like ask these chatbots, how do I do this? How do I do that? But at the end of the day, it still requires a lot of human input because these artificial intelligence or these tools are not on the level yet to communicate on your behalf. They can help support you, but they can't like do customer facing roles, or they can't actively like maintain the relationships yet. Insurance service is also another part of retail banking that offers clients a wide range of risk management and assesses protection services, enabling customers to feel financially secure. Automated underwriting process of risk assessment is done. So under insurance services, of course, they're going to be carrying out risk assessments, and it's done by RPA or bots or robots as they analyze various unstructured data sets and sources to assess risk so that the best rates and coverages for clients can be obtained for insurance. RPA bots can expedite the high volume of claims filing procedure, leading to faster claims processes. The retail bank offers these claims and will contribute to proper claims management. Furthermore, these chatbots are used to answer customers' questions, strengthening communication, customer support. I will talk about mortgage lending, which is also another part of retail banking. That's retail banking, which involves like lending borrowers loans so they can refinance their homes. Automation in lending services lead to accelerated mortgage loan application, faster loan approvals, and streamlined underwriting, which positively affects a lender's efficiency. So I'm going to describe the automation happening in the loan process. So firstly, loan origination software automates the issuance of mortgage loan, as mortgage loan applications are streamlined through fast collection and analysis of initial borrower information before it is passed down to underwriters. Then automation in underwriting mortgage loan involves using machine learning and robotic processes to evaluate the risk associated with lending to a particular borrower. And then mortgage loan automation is done by assessing credit reports, assets, employment history. And finally, the last stage of it involves loan servicing, which loan servicing automation involves collecting timely mortgage payments through automated payment systems like an escrow account. So this was just the automated mortgage loan processes. Usage of these mortgage loan automated software like Blend involves automatic data validation and automatic pre-approval features to reduce the need for inputting easily guessed information based on the data inputted previously. So these features provide a seamless customer experience and fosters better customer engagement because it means more customers are likely to complete the application if they're inputting the data already, that smart data basically, if they're filling out the information already for you, the mortgage loan application becomes much less time consuming, tedious, and people are more likely to finish it when they get started. Then again, I'm going to talk about consumer lending, and then I will explain this graph that I have on this slide. Consumer lending is another type of lending undergoing automation in retail banking, which involves like lending, as you can see in this graph, like involves auto and personal loan services, which are being streamlined at an increasing rate. PwC states that like consumer lending customers who are like customers in consumer lending, they're not only attracted by lower interest rates, but also by other factors like customer service, channels, transparency, and all of these could be improved by automation. For instance, the full potential of automated consumer lending services is yet, okay, even though there is a lot of softwares that can be used for like automation in mortgage lending, digital solution platforms are making consumer lending process much more simpler and faster, like giving workflow visibility so consumers and employers, they could both see where the particular loan approval process is. It's not has not been at its full potential yet, so there's still a lot of room for automation there. Mortgage, if you see the graph shows the effect of automation and technological innovations in retail finances, mortgage lending, and also auto lending market on the left side. Even though automation has a set of benefits, as discussed previously, it disrupted mortgage lending more around 2010 than currently, because auto lending increased in 2022. These trends on the left side are demonstrated in like the first two graphs, like as I've mentioned. On the left, you can see that from the graph that mortgage lending in 2022 was close to 1 million, but loan lending was close to 4 million. This relative lower mortgage lending might be because of high interest rates or on mortgages, or a lower supply of houses available for sale. Thus, even the automated mortgage loan origination, underwriting, and loan servicing make the mortgage application more straightforward, it is not of much help as other external factors such as interest rates and housing supply also come into play. Well, unlike the mortgage market, the value of auto loans spiked in 2021 to 738 billion, as shown in the bar graph. The spike might result from progressive advancement in automated underwriting, automated fraud detection, and automated collection of payments, among other factors. So correct underwriting of loans with no room for fraudulency and better collection methods, which is possible through automation of loans, explain why the value of auto lending went up in 2022. As a result of like technological advancements contributing to streamlined software equipped with fraud detection, underwriting, money collection, etc., we see factors like why these increases are happening because of sophisticated approaches. Other than the sophisticated improvements that I've talked about in automation, which led to those increase in lending amounts, you can see in the graph. Other factors also played essential roles in the increase of auto loans in 2021, such as in popularity of used cars, for instance. The upward credit migration, as you can see, was on the right graph. It was also possible because of automated underwriting, fraud detection, and collection methods because developments in these fields are closely linked with credit migration. For example, like automated auto loan underwriting aids in selecting borrowers who are less likely to default on loan and have a high repayment history through the appropriate risk assessment. So there also the automated collection methods also enables borrowers to repay the loan on time, thus improving the credit score factor. So the appropriate risk management while giving auto loans and collecting them efficiently improve the overall credit score level and cause the credit migration of the population from, as you can see on the graph, from subprime, non-prime to prime score levels. You can see on the stacked bar chart here. Moving on to sales and trading. Well, sales and trading are and also encompasses of like various subfields, as you can see, like equity, fixed derivatives, and it's also a subfield of finance. So what sales and trading, and like we know that algorithmic trades are being used for automating trades on a large scale. Automated trading systems or algorithmic trades have several advantages over human or manually done trades. I'll move on to equity trading, which is again buying and selling of equities, stock equities in the hope of profit. Automation is changing the natural order of equity trading. For instance, like Goldman Sachs trading desk employed 600 traders in 2000 to buy and sell equities, but currently they have just 2 equity traders left. So that just gives us an idea of like how these equity traders are losing jobs and how this process is being automated. Around 44% of the equity traders surveyed agreed that the regulatory reporting is the area of equity is the area under equity trading that's undergoing the most automation. As the automated regulatory reporting, there might be what falls under these automated regulatory reporting, the specificities of each executed trade, like such as time, date, quantity, amount, etc., which was manually inputted by the employees before it has been taken over by softwares and automation tools. Moving on to the fixed income trading, which again involves buying and selling of fixed income securities. Automation is becoming actually mandatory rather than optional for fixed income trades, as these trades face increased competition, lower price, and narrower margins. This intense pressure to maintain efficiency and strive for competitive advantage might be why cloud solutions are being integrated with fixed income market. Adding the strengths of cloud computing with fixed market functionalities will deliver excellent results, because the cloud's limitless, like cloud's capability, like limitless capability, will help evaluate the bond prices accurately and quantify the liquidity of fixed income securities. Previously, these price evaluations were done manually, which would leave room for error. Evaluating bond prices properly will result in proper pricing and of the bonds correctly. So again, it gives automation and fixed income gives crucial information to the employees, people involved, about the real-time pricing, news, charting, which is needed for the pricing of securities, like fixed income securities, like bonds, for instance. Even though automation is happening in this field, the percentage of electronic automation of fixed income securities is low, because fixed income market is fragmented and illiquid. So the fragmentation might be because of like 2 reasons, especially lack of centralized trading exchange. So that means there's no single exchange to facilitate trade, as it's traded over the counter between buyer and seller, so there's no fixed exchange. And also it's impossible to monitor the prices of fixed income securities due to the individual trades happening. Moving on to the derivatives market, just like fixed income, automation is also happening in the derivatives market. And I will talk about it so automation as I've mentioned before, like due to these reasons, like the fixed income securities are becoming very fixed income security. So automation just like I've mentioned about fixed income market, automation is also happening in the derivatives market, which refers to buying and selling of financial instrument called derivatives. The over-the-counter traded derivative market is highly unregulated, as in that adequate information is not being disclosed between the two parties, and like there's a gap, and there's a gap between the two parties engaging in trades because the traders are the knowledgeable investors. Then, however, this lack of transparency between the two parties can cause like concerns in market integrity. So cloud-based softwares like Ferrum uses a blockchain decentralized ledger to add transparency for traders and a level of verifiable compliance. Thus, using softwares like Ferrum would mean that traders would be able to get more disclosure on who they engage in trades with, and the regulators would be able to oversee if trading guidelines are met. So that's just one way that more transparency is being added in derivatives trading. And as for sales, the sell side benefits of streamlined processes is that automation extracts value from data, making necessary information available or accessible. So these availabilities and accessibilities of unlimited data using advanced artificial intelligence will aid in making equity selling decisions. So like when to sell. However, despite the benefits it can be inferred, just like CRM I've mentioned about the customer relationship management, how that's fully difficult to automate. This is also difficult to automate because again, strengthening relationships and sales, and unfortunately, artificial intelligence and automation are not on that level yet to take on client-facing roles. Moving on to the financial management segment. So as you can see that financial management also encompasses financial management. Automation is also happening in financial management of the corporate finance. Moving on to the financial management segment, it consists, which again, what is financial management? It is like basically efficiently managing financial resources and assets to optimize allocation and profitability. For instance, automation in financial management uses automated financial reporting analysis, risk management. So like all the previously other functions that I've mentioned before. In addition, it also consists of asset allocation and portfolio management, which are also parts of financial management. It allocates assets across various asset classes and oversees allocation. Automation in asset management is hard to achieve because of a lack of standardized goals and fragmentation, as there's like diverse investment products and regulatory jurisdictions. However, there's always hope that it could be achieved successfully, which will establish a unified workflow. In contrast to asset management, portfolio management is undergoing rapid automation, as unified automation platforms like single portfolio management solution gives investors a thorough understanding of the portfolio, enabling them to monitor the performance, identify the patterns, and make informed judgments on like which portfolio to select. Then let's move on to the commercial banking aspect. Finance that's also undergoing automation. It means using all the automated tools that I've mentioned before, like cash management, treasury management, risk assessment, compliance, financial reporting. As I elaborated before on corporate finance section. In addition, commercial banks have also started to use trade flow automation, which you can see on the last bullet point. Trade flow means using financial products and tools to promote global trade and commerce by introducing third parties like banks to transactions. Automation in trade finance is specifically happening in trade application process, which involves customers submitting orders in the portal, optical character recognition, converting the submitted information to digital data, and then document classifier automatically classifying the document, the natural language processor extracting the value, and artificial intelligence like checking the data. So the automated application process is faster than the manual process of performing trade application, which again is more labor, but less added value. Again, moving on to payments and fintech, the payment sector is another growthful sector that is undergoing automation. Payment automation is achieved by centralizing invoice and payment processing through encryption, enabling payments and accounting software to share data via an API integration, and finally eliminating manual double entry. So this automated centralization of payment processing, data sharing according to data sharing between softwares, and then API integration connectivity makes transactions more straightforward and simpler than having to write checks for sending money. Also, like we see that financial institutions such as banks, they're trying to keep up with Silicon Valley by adopting artificial intelligence and investing in fintechs. The industry is looking forward to hire more individuals who specialize in data science, artificial intelligence, machine learning, rather than those specializing in finance-related field. I will move on to the next segment of the graphs. So this is basically a key finding a part of the presentation where I will elaborate on what I found out. So even though the research outlines various parts of finances undergoing automation, the process has yet to become full scale. Automation is the future of finance, but not all subsections of finance is undergoing through automation on the same level. For instance, the finance area is currently undergoing massive automation are like bookkeeping and transactional activities like cash on disbursements or something, but other functionalities are not undergoing such massive scale automation yet, and because it is costly to implement, right? On top of the cost, it takes work to automate all parts of finance due to the nature of it. Due to, for instance, like fixed income trading or asset management is more complex to automate than payments and financial reporting. The complexity to automate in these two particular areas of finance is because both fixed income and asset markets are fragmented with diverse securities and asset classes. So it is challenging to like standardize procedures of like centralized automation. Only 13% of finance executives are using artificial intelligence, analytics, and automation to transform business processes. Thus, we can like kind of infer that like technology is not being used on a vast scale to automate financial functions because, again, as said before, these are also in the very initial stages of automation. Automation helps various parts of financial sector, such as corporate, finance, retail banking, sales and trading, the transactional side, but most of the teams have not fully adopted to advanced technologies yet. The low adoption of artificial intelligence across financial teams imply that even though like practical data analysis help forecast automated future of various fields, the actual implementation still like needs to be done at a considerable level. However, it is best like to prepare for the future by gaining skills that are relevant. The graph on the right, as you can see, the blue one, the graph on the right shows like which field will require over the next 1 to 3 years, which skill is going to be of demand. And as you can see, data science is 72%, which is the highest on the graph. So the most in demand is, again, STEM degrees, which are still preferred over finance because technology and automation are the future. Even the finance has not gone through full automation yet, choosing non-standard roles that require interpersonal skills, that's safer. You can see on the left graph that the general the services that are difficult to automate. And then again, you can see the automated one. The automated ones are the ones that are transactional and regulatory, and it's more like on the clerical lower level jobs. And then the one that's difficult to automate are the ones that require creativity and require some sort of like using business development. That requires creativity, that requires thinking, and that is difficult to automate because again, it's not, you can't rely on artificial intelligence to do it. So, but then cash disbursements, as I've mentioned before, are being like automated. So, and they're somewhat you can see on the graph on the left side. So that again proves my point that again, creative thinking, choosing skills, interpersonal skills, and which means should us having like strategic thinking skills and yeah, using those to survive rather than, so the best approach to survive in future is to combine human intellect with automated services to achieve a maximum efficiency. Yeah, not fully relying on automated services, but combining them both and using creative thinking is the way to go. My next slide, I basically talk about the drawbacks, which I've already mentioned before. Drawbacks, well, the first drawback is it's not happening as it is expected to, or as like I've researched, it is not, all the fields are not undergoing automation, sadly, which again is kind of good because means a lot of the employees are not losing employment currently, but that shouldn't stop them from enhancing their skills, creative thinking, analytics, strategic thinking, all those kind of skills, and doing a client facing role rather than like back office roles. But yeah, it's not happening as expected. It's costly to implement because again, as I've mentioned before, the initial stages, you have to like implement a lot of resources and money to get those automated services. But once it's in, then you can reduce the cost of, like, you don't have to pay employees that much, you can cut down on employees, and then it's costly to implement upfront. And then it's just too much prediction happening at this point, like what's going to happen in a couple of years rather than it's happening right now. So yeah, that being said, I would like to end my presentation. Hope you enjoyed it. Thank you.